So the Fed finally cut rates by 0.25%, and if your feed looks anything like mine, you're seeing people celebrating like we're heading back to 3% mortgage rates all over again. Let's slow down and pump the brakes, because while everyone focused on the rate cut, what actually matters is what Jerome Powell and the Fed said about their balance sheet. And that's the part most people completely missed. And so if you saw my video on other platforms on Monday, pay attention, this is basically part 2. According to Reuters and Bloomberg, the Fed announced it will end its balance sheet reduction around December 1st. This had been speculated in recent weeks, which is why I covered it on Monday. That means they'll stop letting their bond portfolio shrink. The idea is that people were hoping that those funds would actually be reinvested into mortgage-backed securities. This kind of behavior and buying is what would help push mortgage rates lower. Here's the kicker. Powell said they're not going to do that. Instead, the Fed will be putting that money into Treasury bills, not mortgage bonds. So what does that mean in plain English? It means the Fed is still pulling away from directly supporting the housing market. They're stabilizing the overall financial system, not targeting mortgage rates. And even though the Fed funds rate is now lower, the bond market actually ticked upward on fears of future inflation. And maybe that the Fed cut a little too soon. That's why you're not seeing an immediate drop in mortgage rates right now. In fact, they edged up just a tiny little bit, nothing dramatic though. Here's something else that isn't getting much attention. Even Fannie Mae, one of the biggest players in housing, doesn't expect rates to come down much over the next 2 years. Their most recent forecast shows 30-year fixed rates staying around 6.4% through 2025 and only dipping slightly below 6% by the end of 2026. Although, since they made that statement, there has been some talk they may try and directly influence conventional rates themselves. I'll do a little bit more on that tomorrow though. Bottom line for today, the Fed's trying to walk a fine line here. They have to cut rates and calm markets, but they also have to avoid inflation. So before you celebrate the cut, remember, they just told us they're not coming to rescue mortgage rates this time. That's the part nobody's talking about. Now, if you want to see what that means in terms of rates for you today, go ahead and comment or reach out. Licensed in Arizona, Oregon, and Washington, I'm more than happy to help you out.